In the month of May alone, I made over 543k live trading. And the best part is every single trade was documented live on my second channel, Brad Trades. Alright, so there we have it guys. Today we made about 206k on this trade itself. So in this video, I want to break down one very specific entry model, one very specific strategy that a lot of traders use to make a lot of money in the market, just like what I've done for myself. Now, a lot of you who trade ICT concepts probably know this as the silver bullet strategy, the holy grail of trading. But I'm not here to repeat the basic textbook version. What I'm gonna do in this video is to break down through my own lens, based on my own trading experience, based on the data that I've collected, based on the way that I personally think about liquidity, timing, and execution. So I guess you can call it the golden bullet strategy. The golden bullet strategy? Yes? Alright, the golden bullet strategy, let's go. Okay, so first of all, what exactly is a silver bullet strategy, right? It sounds so fancy, it sounds so phenomenal, but is it as good as it sounds? Well, the silver bullet strategy is basically a time-based intraday trading model that is built around liquidity, structure, and displacement. So quite simply put, it allows you to enter at the best place at the best time so that you can catch high risk to reward trade setups. So to make things even more simple, just understand that the silver bullet strategy allows you to make a lot of money in this market itself. It's proven, it allows you to get sniper entries, right? Like, it's awesome, okay? So it pretty much comprises of 5 steps. The first step is that price sweep liquidity. Remember, liquidity is essentially the fuel that the market needs in order for it to drive price up or down significantly, right? So it has to sweep some form of liquidity. So that's the first step. And usually there's gonna be liquidity sitting above swing highs and below swing lows, right? So in a silver bullet strategy, we're expecting price to go up there and sweep the prior high that was established during the previous trading session. So basically, we want to see price take out an obvious high or low, right? So in this case, if you are trading Forex, ideally we want to see price take out the London high or London low, right? Which is the previous session high or low, right? So if you're trading the New York session, then guess what? London session came before New York session, so we want to wait for price to sweep the high that was established during the London session, and then once they swept that high, then we are looking to short it down. And then if it was an uptrend, then we want to see price sweep the low, and then once price sweep the low, then we are expecting price to move up. The idea here is very simple. Before we get the real move, we want to see price grab liquidity from one side of the market, and then we can look to short it down or long it all the way up. The next step is price shift market structure, right? So obviously we want to see a confirmation that tells us that the trend direction has officially shifted, right? The trend has officially shifted from bullish to bearish. So this means that in an uptrend just like this, we want to see price take out the last low. If price take out the last low, this tells us that we got a market shift, the trend is reversing from bullish to bearish. Okay, so once again, if price sweep the high, we want to see price take out the low. If price sweep the low, then we want to see price take out the most recent high, giving us a market shift to confirm to us that smart money is indeed using all the available liquidity that it has just gathered to fuel price, to cause price to move in that opposite direction. This shift in structure tells us that the momentum is changing. The next step is that price have to create displacement. Right, what displacement basically means is a lot of momentum, a lot of pressure, a lot of volume in the market itself, right? So after the market shift itself, we want to see price just go down very, very aggressively, right? So we do not want to see small, tiny candlestick right here. We don't want to see slow price action. No, we want to see strong displacement. We want to see a lot of selling pressure, a lot of selling momentum, which really tell us that, hey, smart money is actually using all of this fuel right here to cause price to move down very significantly. Once again, confirming to us that supply has exceeded demand, sellers has overwhelmed the buyers, and right now the sellers have to take back control of price. So we want to see clean displacement, strong momentum, because displacement tells us that one side of the market has taken back control of price. Then the next step is that we want to see price pull back to an entry model, right? This is so that we can get a much more optimal entry. Because if we enter for a sell position right here, we will have to place our stop loss at the last high, which is quite far away, right? So it's not going to be an intelligent risk to reward decision. So ideally, we want to wait for price to pull back to a entry model, a point of interest, so that we can enter right there, place our stop loss above that point of interest, get a much more tighter stop loss, and just limit our downside and just have a much more greater upside, right? Which is why the next step is to just very patiently wait for price to pull back into an entry model after the displacement has occurred. Now, in terms of your entry model, there's a few entry models that you can use. There's your fair value gap, there's your order blocks, there's your demand zone, there's your flip zones, right? You basically just want to wait for price to pull back to an area where smart money, institutions, big banks are most likely going to enter into the market again, and then try to ride the move before it actually happens. Okay, so yeah, I've done a lot of videos about this. So if you want to find out videos on fair value gap, order blocks, or whatever, you can just go and search that term plus the Trading Geek, right? So fair value gap, the Trading Geek on YouTube, you'll find a tutorial where I teach you how to use these entry models itself. But yeah, for simplicity's sake, in this video, we are just going to assume that the entry model that we're going to be using is either going to be a fair value gap or an order block or some form of demand zone or supply zone, right? So I'm just going to wait for price to pull back to a zone in which institutions are getting involved, and then I'm just looking to trade from there. The final step is price targets the opposite side liquidity, right? So you must understand that the market is always seeking liquidity because that's the fuel it needs to actually move price, right? So in this case, if you are looking for short right here, we are going to be targeting the opposing liquidity, right? So I'm most likely going to be targeting the next low, right? Because we know that there is available liquidity sitting below this low right here. So this is where I can enter for a sell right here, target this low over here, and then perhaps when price comes down to this low, it can sweep this liquidity and reverse, and guess what? We will get out of that trade with a very profitable, with some money basically, right? But because of the fact that there is liquidity below this low right here, we do not know whether price is going to reverse at this area or it's going to continue going down. That is why we place our take profit right there, because that's the area where price is most likely going to reverse after sweeping that liquidity. So ideally, you want to target the opposite side liquidity. So basically, if price sweeps the high, shift bearish, and give you a short entry, you want to be targeting the most recent low, right? You look at the left hand side, see the most recent low that was established, and that's your target. And then if it's an uptrend, right, and price comes down, sweep the low, and give you an opportunity to look for a long position, then ideally you want to be targeting the most recent high, right? Because that's the opposing liquidity. So yeah, that's pretty much the entire silver bullet strategy in a very simple format. It comprises of 5 simple steps just like this. Now, before you go on to the charts and apply what we've just learned, right, where I show you the exact rules of the entire silver bullet strategy, I want you to understand one thing. Timing matters way more than most traders think. Yes, it's about developing the right trade idea, determining where to buy, where to sell. Yes, it's about marking your charts with market structure, supply and demand zones, identifying the fair value gap, all this stuff, right? Just really making sure that you have done your analysis, preparation, and research. Like all of that stuff matters. But a good trade idea that is executed at the wrong time will still fail. Right, so you need to have the right trade idea present itself at the right time, which is why the next piece of the puzzle to the silver bullet strategy is the timing, right? Is what time are you going to be looking for the entry model? What time are you going to be analyzing the charts? What time should you be looking for this pattern itself? Understand that just because the market is open 24 hours a day does not necessarily mean that your edge is present in the market for 24 hours a day. There are going to be certain times in the market where there is more opportunities than usual. There are going to be certain times in the market where your strategy performs better or price move cleaner. There's going to be times, there are certain times where there is the perfect amount of volatility, liquidity, volume, and momentum. And those are the times that you want to be trading. Now, I was telling my students this analogy that I came up with a few days ago during one of my coaching calls. I told them that trading is kind of like archery, right? And imagine you are archer. You have a bow and an arrow, and then there's a target board right in front of you. You want to get a bullseye, right? You want to shoot the arrow into the target board. But you can either make it easy for yourself or make it difficult for yourself to hit the target board. And what I mean by that is that if you trade within your Q zone, which is the best time to trade, right, which is the perfect trading window, it's as though the target board is only 10 meters away. But if you trade outside of the trading window, as if that the target board is 10 kilometers away. So it's like you can pull the string, you can aim at it properly, you can do your preparation and training properly. But because of the fact that the target board is so damn far away, your shot might just be missed because of the wind, because of a lot of other variables, and all because of the fact that you just didn't trade during the right window. Yeah, so basically what I'm trying to say is that you can do the same preparation, the same analysis, the same research, right? The same chart markups, the same trade plan, but because you trade at a different time, now you get a completely different result. Now you're playing a game that has a completely different difficulty level. So yeah, that's a very important nuance about the silver bullet strategy. And that's what makes it so powerful, right? Because it doesn't just tell you what to trade, but it also tell you when exactly to trade. Like, hey, trade during this window right here. Because if you trade during this window, this is where there is a higher chance for your setup to actually play out. And if the setup appears outside of this window right here, it's none of my business. I'm more than happy to pass on the trade idea itself. So ideally, I want to see the setup appear within this window itself. All right, with that being said, let's go on to the charts where I'm going to show you how to apply this silver bullet strategy to both Forex and indices. Right, so I'm going to show you how to do it on Forex first, and then later we can go on to indices like NASDAQ. Okay, so first of all, these are the steps right here. I've placed it on the screen for you to like just go and follow step by step. The first thing we do is to really just make sure that we mark up the Asia or London high and low, right? Because remember, the first step is to always get the liquidity sweep. But before we can get the liquidity sweep, we have to identify where is the available liquidity. So if I'm trading during the New York session, this is where I'm looking at the left-hand side to identify where is the low or the high that was established during the London session itself. And ideally, I want to see price sweep that low or high. Okay, so in this case itself, right now we are in the New York session, right? And if I look at the left-hand side, I can see that this was the low that was established during the London session, and then the high is somewhere up here. Okay, since price is so far away from the high right now, and we are officially already in the New York session, there's a very low chance that price will come up there and sweep this liquidity right here. Instead, price is actually near the low right here, near the London low, right? So this is where I'm expecting price to sweep that low right here. So this is where I'll take a line to, and I'll just mark that up as available liquidity, right? So I know that, hey, maybe later, over the next few hours, over the next few minutes, price can come down there and sweep that low itself, right? So in that case, first step done, right, is to just mark up the London high or the London low, right? So in this case, I'm not even going to bother to mark up the Asia high and low, right? Because the London low was so much more lower than the Asia low, right? So this means that sometime during the London session, price has already swept the Asia low itself, right? So that's not really like relevant to me anymore. So I'm just going to mark up the London low. And like I said, I didn't mark up the London high because price is already all the way down here and is most likely going to gravitate towards the nearest structural low to grab that liquidity and reverse. So yeah, this is where I'm targeting, or this is where I'm expecting there to be some form of liquidity sweep. Next thing is to just do nothing until that gets swept, right? So in this case, do nothing until price comes down, sweep the low. The minute price comes down, sweep that low, this is where I'm getting intrigued, right? This is where I'm getting interested as to like what price will potentially be doing. All right, and then if you guys recall, step 2 is basically to just wait for the market structure to shift after the liquidity sweep, right? So in this case, price of liquidity, right? Step 1 done. Next, we wait for price to shift market structure to tell me that smart money is indeed using this liquidity to cause price to move to the upside. And then this is where perhaps we can jump down to the 1 minute time frame to look for our entry. Right, so I'm not going to dive too deep into like the top-down analysis and how to map out your supply and demand zones and do your multi-time frame analysis in this video, because once again, I have separate videos on this. This video is just going to be fully focused on this entire entry model, this entire strategy, right? But if you guys want to learn about how I analyze the charts from top to bottom, you can check out like my free mentorship series, link in the description. But anyways, back to the video itself, right? This is where I'm waiting for price to shift market structure, right? So if you look at the market structure right now, what we have was price goes down, pulls back, comes down, pulls back, and then goes down even further, right? So this becomes the most recent low, right? I mean the most recent lower high. So if price comes down and take out this recent lower high, this is an indicator that tells us that the market structure is officially shifting bullish, right? So I'm not doing anything until price take out that high. Boom, began to take out that high right here. Step 2, done, right? So this is why we literally saw price create a very sharp V-shaped reaction just like this after sweeping the liquidity on the left-hand side right now. And then we also see price coming up there and taking out this last structural lower high right here, giving us a market shift just like this. When we have a market shift, the next step is that we want to have a very strong momentum, strong displacement, right? We want to see a lot of buying pressure, a lot of buying momentum. So observe the candlesticks that's formed right here, right? So after the market shift, price goes up very aggressively, okay? So this is what I see. I don't want to see choppy price action. I don't want to see slow price action. I don't want to see small candlesticks. I want to see big momentum stepping into the market, really just displacing the freaking sellers, right? Really just show us that the demand has indeed overpowered the supply. So at this point of time, we got a displacement, and guess what? We are pretty much done with like the first 3 steps, okay? So price of liquidity, price shift market structure, price creates displacement right here, cool, happy days. Now the next step is to just wait for price to pull back into the entry model, right? So this is where we are starting to look for our entry. Okay, now where exactly are we looking for the entry? Remember, we only want to enter when price pull back, right? Not in this initial phase when it's breaking out. No, we only want to enter when it pull back. Okay, so once again, for simplicity's sake, we are just going to be using either the fair value gap or the order block in this video right here. So for the fair value gap, it's basically going to be an imbalance in price, right? So what I mean by that is that you want to be identifying a gap where there was a strong amount of buying momentum or selling momentum. In this case, since price is bullish after the liquidity sweep, we want to identify like the place where there's a lot of buying momentum and try to find that gap, right? So in this case, if you zoom in over here, you can see after here, price comes up liquidity, price reverse very aggressively and hit back up just like this. So this is where I'm looking for the gap, right? And what I'm searching for is a very strong big bullish candlestick. And what I want to see is price leaving a gap just like this. Okay, so you can look at this candlestick right here, right? This is where we got 3 very bullish candlestick. And this is where you look at the first candlestick and the third candlestick of the sequence, and you map out the high of the first candlestick and the low of the third candlestick. And if you do that, you can see there is a gap right here, right? This becomes our fair value gap or becomes our imbalance. Once again, I did a video that is really covering this entire concept of fair value gap and imbalance. You can just find it inside my YouTube channel, right? If you want to learn more about this, learn about the different nuances. But for now, once again, just to keep things simple, just know that this is the fair value gap, and ideally we will map that up as like a box just like this, and we want to see price pull back to this area right here, and then this is where we can look for our entry, and then we can try to target the opposite side liquidity. Okay, so yeah, once again, we do nothing until price comes down to the fair value gap. Boom. All right, so this is where you'll be tapped into the trade itself once price have mitigated the fair value gap, and this is where you're going to be placing a stop loss below the fair value gap itself, and you're going to be placing a take profit at the opposite side liquidity. Now, where can you find the opposite side liquidity? Like I said earlier, if you are looking for longs, you want to be targeting the nearest highs. If you are looking for shorts, you want to be targeting the nearest lows, right? So in this case, since we are looking for longs, we want to ask ourselves, okay, where is the nearest swing high? Because that's where we're going to be targeting. Okay, so if I'm looking at this chart right here, what happened was that price comes down, pulls back, comes down, pulls back, right? So this becomes the nearest high. So ideally, we should be targeting somewhere around here, right? Because we know that there is going to be available liquidity above this high. So what can potentially happen is that price can come up there, swap that liquidity, and then start going down. Okay, so to keep things very simple, keep things very mechanical, I'm just going to be targeting this high right here. Okay, so yeah, that's where I'm going to be targeting. I'm going to be targeting the opposite side liquidity. I'm going to be managing my expectation when it comes to this trade itself. I'm not targeting the moon. I'm not like trying to target all the way like up here or something. I'm just going to be targeting this opposing liquidity right here because I'm expecting price to move toward that area here. and sweep the liquidity above this high. And then when that happens, I don't know what's going to happen next, right? I don't know whether price is going to reverse against me or like just continue going up. But I do know that price is going to be moving toward that area because that's where there's going to be the next available liquidity, right? So that's where I'm going to be targeting right there. And just as expected, price went all the way up there and smashed our TP. Literally as simple as that. And just observe what happens next, right? Price later on continued consolidating and then started going down. And when it go down, why did it go down, right? Price went down because it swept all the available liquidity above this swing high, which is why, once again, we targeted that high and then come all the way down here. And then when price come all the way down here, where did it go down to? Well, it go down to sweep all the low that was established right here, all the available liquidity below these lows right here, and then started reversing and heading back up. Right, so yeah, in this case, you can see if you apply the same sort of strategy again, this is where we can perhaps see price came down, sweep the available liquidity below this low here, right, and then give us a fractal market shift right here. And after we got a market shift, we got a shift in market structure, price create a strong displacement just like this. And then this is where perhaps you wait for price to pull back to your entry model itself. And then if there is available liquidity, then price will continue going up. If there's not enough liquidity, price is just gonna go down, right? So in this case, what happened was that price later on came down here. There was not enough liquidity for price to continue going up. Okay, so this is where price came all the way down here after the fractal market shift. Not enough liquidity. Guess what? Price will go down here, grab more liquidity. And where's it going to go down and grab liquidity from? Well, perhaps below this low right here. So after it come down here, grab the liquidity below this low. Then guess what? Price of liquidity, later on price shift market structure, price take out the last lower high. Right here, price creates a strong displacement just like this. And this is where perhaps you can wait for price to pull back to an entry model, a fair value gap, order block. And then this is where you can look for longs and target the opposite side liquidity. As simple as that. All right, next up, we are going to look at NASDAQ, right? So this right here is how you can apply the silver bullet strategy to NASDAQ or for indices in general. The first thing you want to make sure is that you are trading at the right time, right? So like I said, timing is so important. Ideally, if you're trading NASDAQ or any other indices, the best time to trade it will probably be sometime during the New York session, right? Sometime after the New York Stock Exchange has opened. Okay, so yeah, first step first, if you are planning to use this strategy, you want to make sure that you mark the 9 a.m. hourly candle high and low once the candle closes at 10 a.m. Eastern Standard Time. Okay, so this is the New York time zone. You want to make sure that you are just defining the range where price is most likely going to sweep the liquidity. Okay, so in this case, this is 9:25, right? So it haven't been like 10 a.m. yet. So let's wait until like 10 a.m. And then once 10 a.m. has appeared, right, somewhere around here, this is where you will start to see the 1 hour candlestick has closed. Okay, so if I go up here and I can see right here, this entire 1 hour candlestick has closed right here. So this is where perhaps you can mark up the high and the low of this candlestick itself. And ideally, you want to see price either sweep the high or the low, and then you can act accordingly, right? So what I basically mean by that is that if price sweep the high, then you can look for shorts. If price sweep the low, then you can look for longs. It's really just as simple as that. This is where I'll take a line tool just like this and mark up the high of the candlestick and also the low of the candlestick just like this. Okay, so once again, this is our hourly candle. I'm on the 1 hour time frame and the candlestick has just closed at 10 a.m. Eastern Standard Time. The next step is to watch for a sweep from right now all the way until 11 a.m. Eastern Standard Time, right? To see whether price actually sweep the high or the low and then act accordingly. So let me jump back down to the lower time frame itself, right? So once again, this is the range that we have defined, okay? So let's see what happens next. Okay, cool. Price has literally just went up there and swept the high. All right, so let me just play back a little bit so you guys can see exactly what happened. Right, so this was around like 10:05, okay, around 10:05 right here. Remember, we have marked the high and the low on the 1 hour candle. And we have also mentioned that if price swept the high, we are looking for short. If price swept the low, we are looking for longs. As simple as that. So in this case, let's see which one price actually swept. Right, later on, price went up there. Okay, seems like sweeping the high. Okay, continue going up, sweep the high right there, and then start coming down. All right, so this is where you can look for shorts. If you are aggressive, you can even just like look for a short here, right? You don't even need to wait for price to pull back. You can just look for short right here. And then just try to trade it all the way down, place your stop loss above the high, target the opposing side liquidity, which is going to be below the most recent lows, maybe somewhere around here, if you are aggressive. Okay, and also another evidence that we can use to like support this short is if you look at the left hand side, what do we have? Well, we got price going up there, pull back, goes up, right? This is our breakout structure, which means that this becomes our market shift. Okay, so we got a market shift right here. Very cool. And we also got perhaps some form of liquidity sweep, right? Where price actually came up there and swept the available liquidity maybe above this high right here, or maybe above some prior highs that was established a few hours ago, right? So once again, if you apply the same silver bullet framework, you will see that, hey, we got a liquidity sweep, we got a market shift, and right now we are just waiting for price to pull back to a fair value gap. And where's the fair value gap? Well, it's somewhere around here, right? So if you actually look at it closely, you'll realize that it's kind of like the same sort of framework where if you were trading during 9 a.m. to 10 a.m., perhaps this is where you were first entered into the trade itself, right? But if you are already trading after 10 a.m., right, which means like you follow this framework right here, you have missed out on this opportunity to look for short, right? This is where your second window of opportunity has opened, where, you could have entered for a sell right here if you were trading during that New York session, right? But because you failed to do so, now you just wait for price to sweep the hourly candle high and low. Okay, so this is where you wait for price to sweep the hourly candle high, which is this high right here. Okay, sweep that high right here. Okay, cool. They look for shorts, right? And then you can see the minute you look for shorts, price just collapse very, very aggressively to the downside itself. Right, and once again, where is it moving toward next? It's moving towards to the most recent low right here to sweep that liquidity before price goes up even further. Right, so yeah, and if you observe what price does next, price started like consolidating around here, right? Because once again, it has already swept the liquidity below this low, and right now there is just not enough selling pressure, not enough selling momentum for the price to continue going down. So as a result, it's just going to consolidate here a little bit, sweat more liquidity before price going down even further. So yeah, that's pretty much how you can use like the same sort of concept, right? So when it comes to indices, once again, there is two ways in which you can approach this silver bullet strategy. The first way is what we just covered on Forex, right? You just do the exact same thing at your trading window, right? So when New York session opens, right, when it's time for you to look for your trading opportunity, you follow the 5 steps, right? You look for your liquidity sweep, you look for your market shift, you wait for price to pull back to like the fair value gap or order block, whatever, after the strong displacement, and then you look to short it from there. Now, the second way for you to apply this silver bullet strategy into NASDAQ or indices in general is to like just mark the 9 a.m. hourly candle high and low, like what I've done right there, right? Hourly candle high and low, just like this. Once the candle has closed at 10 a.m. and then you just wait for a sweep to happen from 10 a.m. to 11 a.m. Eastern Standard Time. And then if price hit the high, you look for short. If price hit the low, you look for longs, right? So it's a much more simpler approach. Once again, I'll leave it up for you to like just test it out to see which one works better for you. I personally just prefer the first method because it's a lot more mechanical, it's a lot more systematic, and it's like much more predictable to a certain degree to me, right? Maybe because I'm so used to doing that, where I'm just waiting for extra confirmation before I look for my entry. But yeah, you can just test out which version works better for you if you're trading indices, and then just based on data alone, go and roll out and just use that particular version that works the best for you. So that's it for the entire silver bullet strategy. I hope that this was a huge game changer because it was for me when I really understood how to combine liquidity sweep, market structure, fair value gaps to determine like a proper trade bias, and also like just overall combining it with the right time to trade. Such a game changer for me. Anyways, if you want to learn more about market mechanics, right, you can just join my free mentorship, link in the description. I have nothing to sell you, right? There is no upsell, no opt-ins. It's a free 33-day market mechanics mentorship series that have actually hosted, right? Not hosting, actually hosted, where I literally mentor you for free for 33 days straight, where I teach you everything I wish I knew about trading 7 years ago, right? So yeah, you can go and check out that playlist, link in the description, right? Trust me, it's gonna be a huge paradigm shift, because you are going to really just change the way you perceive the market. And when you change the way you perceive the market, you change your trading results. So yeah, click the first link in the description, or actually just check out like this playlist right here. I'm gonna pin it like probably somewhere around here. You get my point, all right? So go and check out my free course. And with that being said, remember, you're just one trade away.